Yeah, let's jump into things. It looks like we've got quite a few people on already. I want to wish everyone a good afternoon. Thank you for joining us today. Welcome to the Loan Vision 200 series. My name is Jordan Pavelka, and I am joined by Mark Wilson and Dustin Pfluger of CWDL. They are going to be discussing proper mortgage banking methodology, and that's going to include things like cash versus accrual-based accounting. We're going to look at fair value, assets and liabilities. Does that fair value pertain to, and all kinds of different acronyms, as we were saying before.
Before the call, yes.
Before the call, yeah.
Yeah.
For those of you who don't know them, Mark is a managing partner at DL, and he is responsible for the vision and the direction of the practice. An entrepreneur at heart, his experience as a financial executive allows him to analyze and DL's mortgage banking customers with a client-sided perspective. Dustin is at CWDL, where he works with various clients in the mortgage banking space. He's been practicing public accounting since 2004. Wow, Dustin.
Starting to age myself.
With both national and regional firms focused on providing assurance and consulting services to both public and private companies. And he's been focusing on the mortgage banking industry for over 10 years. So guys, how are you doing today?
I'm doing great. Yeah, thanks for having us. We're looking forward for doing this participating in the webinar today. So hopefully we can provide some value for everybody on the call.
Yeah, doing great, Jordan. Thank you very much for having us.
Yeah, good. We're excited to have you guys. Before we jump into today's topic, I just want to share a couple of quick housekeeping items. We are recording the call and we'll be sharing it to all registered attendees, as well as posting it to our YouTube, so you guys will always have access to it. All attendees are muted, but we do want this to be interactive. So if you have any questions, you can send them to us at any time in the chat box, the Q&A box, or if you prefer, you can always hit the raise hand button and we can unmute you to ask your questions. So gentlemen, do you want to get started? I think what we have up first is you guys are talking about a little bit about what is fair value.
Yeah, that's right. I think we should jump right into it. Just restate what you stated a little bit about asking questions. We really like to be interactive, and we want to make sure that we're answering the questions that come in. The one thing we're going to touch probably not a lot on in your introduction is cash versus accrual, unless somebody has specific questions. I think most of you are on accrual basis if you're using Loan Vision and our mortgage banker, but we'll talk about some of the fair value considerations and how you plan and make decisions around fair value accounting. And then we can kind of circle back if there's any specific questions on cash versus accrual. We're happy to jump into that. So Dustin, so fair value accounting, let's talk a little bit about the assets and the liabilities and what they actually pertain to. You're welcome to jump anywhere, but what about the open pipeline and fair value? I think oftentimes we get a lot of questions around this specific topic related to the open pipeline.
Yeah, I think the open pipeline is probably the most controversial piece of the fair value hierarchy, or whatever you want to call it, for mortgage banks. Overall, if we look at fair value, we got four main assets that we'll get into each piece of them, or an asset or could be a liability. But I was just doing some math on it. I think overall, probably these assets make up between 80 and 90% of, the balance sheet of your total assets. So, that's, I think, why the importance of it and what we're talking about today. But, specifically on the pipeline, when we talk about pipeline, we're talking about, locked loans that haven't been funded yet. They can either be mandatory or they can be best efforts. I think probably most people just looking at the 10D list are probably, delivering most mandatory now, some best efforts.
Yeah, and obviously that's your interest rate lock commitment, right? So that's, as soon as you do that, you have an asset, and we have to treat it under fair value, right? So Go ahead.
Yeah, no, exactly. Fair value is hard on the pipeline. The actual definition, if you want to get into technical terms, and I have it over here, I'm going to read it very briefly. The fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So pretty much what it's saying is that the fair value is what you're going to sell that asset for. The pipeline's the hardest of the pieces, because loans held for sale, your open trades, your mortgage servicing rights, you can get fairly accurate pricing for that stuff. It's the pipeline's got a few variables built in when we talk about pull through. Pricing, the production amount. I mean, so it's a little bit harder to value, and there's some controversy around how much cost you back out. I think everybody's in agreement that knows this industry, that you need to be backing some cost to close out of the overall gross value. But it's really what do you back out, and how much, and that's kind of I think where it comes into getting that value of that asset. Because if you think about it, you're measuring a pipeline. The fair value of the pipeline is the gross side of it, or the revenue side of it, is really a hedge firm is probably going to be helping you mark that to market, or mark that to your investors at any given point in time. So that's fairly easy to determine and tell and back into. It's really this cost side, and what's appropriate is where we get into kind of the controversy of it. So when we do calls for people that are that are new into this space, that are new into backing booking those pipelines, or we tell them use your best estimates. I mean get an estimate of your direct cost. Make sure you're including at least commissions in there. But probably more appropriately, putting some, all those direct costs in there. The one thing that we kind of, I think everybody again is in agreement is that, backing out overhead, applying overhead into your calculation, I think it's, that's probably a little bit much. But definitely
it's probably a little overkill, right? When you start throwing rent and other G&A type of expenses, it becomes a little bit overkill. But definitely LO compensation, any other costs related to completing that loan. There might be some processing fees, other things that are directly related to the manufacturing of that loan. That should be part of that consideration, and the phase or wherever that is in the pipeline, right? If the loan is locked and you're getting closer to funding, a lot of those expenses have already been realized. So you would have kind of a blended rate when you look at that. So all of those things are considerations when looking at that asset. And when we talk about open pipeline, for those of you on the call that are somewhat new to this area, these are loans that have not been funded. They are just locked. So it's your locked pipeline that gets adjusted for pull through. And when we say you're putting a value on your open pipeline, we're really talking about those loans locked that have not been funded yet on that particular portion. Yeah. Maybe you want to talk a little bit about the loans held for sale and some of the differences between that and when you look at it, the way you treat it.
Yeah, no, I mean that's the obvious progression here through the the life cycle. You have a lock, and then it gets closed, and then you have a closed loan or a funded loan, and on that piece. The fair value is obviously much easier to determine. You have usually you have a committed price or a best efforts price if you're doing best efforts, but usually you have a committed one if you're delivering mandatory. Sometimes you'll have an uncommitted price that's still getting hedged, but for the most part, it's usually a committed price, so you know what you're getting for that loan. So at 12/31 you're getting 105 basis points, and it's so going back to the definition, what you're selling that for at that point in time. On the cost side, most of those, or not most, all of those costs should be incurred one way or the other. So they should either be incurred through you've already paid them out in cash, or for something like a commission, you should have already accrued that number. So you don't back any cost out of the loan held for sale side. So it really is a pretty easy number. You can go through and test that number. You should theoretically be able to pull a purchase advice, and you should be pretty close to what that investor paid you for that loan, is what you've booked at the end of the day. And that's from an audit perspective, that's something we can look at. So.
Yeah, and those accountants that are new to mortgage banking accounting, I often say think of that as your traditional accounts receivable. I mean, you've pretty much completed everything you needed to do. You know, you're waiting to get paid on the loan. Everything's been pretty much completed on your side. So, and that's the value above just the known amount on your loans held for sale, right? So that's your additional amount for fair value.
Yeah.
Good. Talk about the hedge positions that are set out there that kind of create that are part of the consideration in booking these values.
Yeah, no, I mean, again, it's another one that's relatively easy to determine the pricing on. Your hedge firm usually has, a trade out there with a broker dealer. They know, what that fair value is going to be. Whether it's, a liability or an asset. I mean, that's a key part of this. We'll get in later in the discussion. We'll get into someone kind of like, kind of the errors or the issues that we see when recording these things. But that's a key thing. I mean, that one can be an asset or a liability. It can flip back and forth based on, how the market's moving, honestly, whether, the value of the loans and the pipeline's going up, then that number, that should be, going down and vice versa. So again, I mean, typically, for all those, I think probably, again, looking at the attendee list, 95% of the people here are using a hedge firm, to do this. And so, they'll value it for you. They give you a value. It's a very straightforward number. You can trace it into, broker dealer statements. You know what it is, and the number. It's not, it's not it's not moving around, and you're not, it's not hard to determine what that number is. So.
Yeah, and it's pretty. You're going to see it. You're going to actually see cash move. So that part makes it nice. Kind of switching gears, we're talking about the actual the lock part and funding of a loan. Let's talk about mortgage servicing rights, the fair value considerations related to that, and I think there's a couple different methods as well. So you want to talk through that a little bit?
Yeah, no, and I think that is, I mean, the last piece of the major four items, I think, on the balance sheet that are valued at, fair value on a recurring basis. I mean, is the more, or can be on a recurring basis, is mortgage servicing rights. So yeah, I mean, mortgage service right, again, it's one that's a little bit, I mean, when I say it's easy to value, it's not, but most of you guys probably use a valuation firm, and when you do that, they, they're experts in that space. They know what they're doing. They use a discounted cash flow method to value it, but that they do bounce that part of their models. Do look at what's currently going on, in the market, and make sure to kind of do a gut check on that. But to get to your point, Mark, I mean, the MSRs, so they're required to be valued on fair value on day one. So when you put them into the MSR portfolio, they're required to be valued there. On a go-forward basis, at any given period, you have an election. Then you have an election whether you want to market to market, so market at fair value going forward, or if you want to record it at amortized cost or market. So what that means is that you're going to amortize that off over the life of the MSR. You're going to have an accumulated amortization, kind of like a depreciation account associated with it. And then the downside to that is you still got to check for fair value, because if the fair value falls below the amortized cost method or the amortized cost value, you've got to write it down to fair value. So that's kind of the key thing. It's, amortized cost is typically a more cumbersome method. You've got to track all these assets, you've got to amortize them. As opposed to, the fair value method where you're just marketing at every period to whatever the valuation says. So I think that's kind of the big pictures. I mean, again, the fair value probably gives you a little bit better picture of what you can actually sell it for, what it's going for. So yeah, I think that's really the big thing between the two differences. So.
Yeah, and I think some of the pitfalls we've seen with clients over the years is oftentimes they'll have an aggressive valuation and then they go to sell it and they take a huge loss in a particular period, or other considerations on mortgage servicing rights. So typically you'll get a range of value, and I think it's important to just take a look at that and figure out what's best given the current market condition. so with that, let's go ahead and move forward. And like, why the heck do we even put everybody through this? Like, why fair value accounting? I mean, I think the calls we get sometimes are from CEOs who are seeing these wild swings in their P&L on a month over month basis, and they're I could feel the beads of sweat coming off their face trying to understand what's going on this sometimes what feels very volatile. So why fair value, and why is it required? So maybe you can talk through that a little bit.
Yeah. So yeah, I mean, I think you kind of give a spoiler there that is required for the most part. I mean, it's when I say that, I caveat that it's required for your derivative instruments. It's required for your open pipeline, whether it's best efforts or mandatory. It's required to value those at fair value. The hedge position's required because that's a derivative instrument. And again, we won't get into the literature and all that. I mean, that gets boring. If anybody wants the literature, let us know. We've got it all. The loans held for sale and the MSRs are a little unique. Those are both technically elections. For loans held for sale, I don't know anybody that's on the low-com method anymore. I mean, that's been 10 years, I think, since I've seen somebody on that method. So for lack of better words, I mean, I think everybody in the market pretty much is on, fair value for loans held for sale. Mortgage servicing rights, again, it's probably, I think, within our client base, fair value is more common. With ours, most people have made that election. The one key thing with mortgage servicing rights, and even loans held for sale for that matter, if you elect fair value, you can't go back. Unless it's a different tranche of asset. So if it's a different, I mean, I guess you could theoretically possibly make an argument that, like, if you started servicing Ginnie Mae, loans, that could be a different tranche and you could value that differently going forward. I've never seen that happen, but that's the key. I mean, I think fair value too, also, it gives you a kind of just a better picture of where you're at. It helps you, kind of project into the future, especially in that pipeline piece. I mean, you know that if that pipeline drops, in half, you're going to see it on your financial statements, because that's the biggest driver of it. Obviously, is production. So you're going to see, that, oh man, our pipeline dropped in half, and then you're going to realize that in cash in 2 months down the road. So it's almost like a mini projection tool there too. Yeah, I mean, I think that's, I mean, in the MSR piece, I mean, again, I think, a lot of people, it gives you, if you are on the fair value method, it gives you an accurate picture of what that is. Now there's definite swings in it. Like Mark alluded to, we get calls, all the time of the swings up and down and what's going on. So that is the downfall to it. But again, going back to what I was just saying, it gives you an accurate picture of what that's worth at the end of the day. So like,
and I always tell people, like, you're gonna have a big swing in your open pipeline because wherever you end that particular month, whatever your pipeline is at the end of the month, is going to have the biggest impact on what gets recognized in income, and then that gets completely reversed out the following month. So if you end the month with a very high pipeline and then you recognize that income that month, and that completely verses out the next month, and you actually fund that whole pipeline and then end with a smaller, if it's half as big, you're going to take a half, whatever the value of that as a half a hit to your P&L. I want to circle back on one thing that somebody asked a question, actually. They want to know what's the most common method for mortgage servicing rights? What method is most commonly used? And I mean, I know the answer, but I'll stick it over to you, Dustin.
Yeah, I mean, I think within our client base, I mean, it's definitely the fair value method. I mean, I don't know if we have any clients that are on the amortized cost method anymore, or lower of cost of work, or whatever you want to call it. Yeah, I mean, yeah, I mean, yes, without a doubt, I think that's the most common.
By a long shot. The other thing is I would say, every now and then we'll run across somebody who wants to put no value on their mortgage servicing rights, which is not an acceptable method under GAAP. So I just want to put that, kind of clear that up, right? We have to come up, there is a value, and it exists. And
well, that brings up an interesting point, real quick, Mark, that we talked about on one of our own webinars, a month ago. We talked about this about a year ago. Actually, it was probably exactly a year ago.
Well, I take that back. Unless there's no value in it, and there really is no value in it. But yeah, go ahead.
Well, that even then, I think we've talked. Me, you, I know Santo's on this call. We talked with him and we were all talking about this last year at this time, that they were coming in with no values, but was that really the case? Was there really no value associated with those things? I think everybody knew that those things would, at some point turn. And, we have clients that have, made a lot of money on kind of hedging their bets and, setting up correspondent channels and stuff like that, because they knew that, hey, this stuff's going to turn and there's a value associated with it. So they could buy it, 50 cents on the dollar and sell it for $1 and made some, good money doing it. So yeah, I just wanted to throw that in there, because we did see a period last year that there was supposedly no value associated with them. So
we had another question pop up there, gentlemen, if you don't mind. Can you share your thoughts on the IRLC value reported in the hedge report, and do you consider that fair value appropriate to the report in the balance sheet, or do you feel that maybe it needs to be adjusted to arrive at a GAAP fair value?
Well, so this is getting into the some of the issues that we'll cover in a little bit, but I think we can jump into it right now. That's a common issue we see, and honestly, to answer the question, it depends. It really does. It depends on. You can get 5 firms that all use the same hedge firm that have 5 different answers to that question, because of the way the data is being pulled into that report. Because at the end of the day, it all goes back to kind of your data hygiene, for lack of a better word, and what's getting pulled from your LOS into your hedge report, and then because some hedge reports they'll have you can build in your full cost to close into the calculation, and you can back that out and you can book it straight off the hedge report. Some they book it at at a gross number, and you then have to estimate a cost to close and back it out. In some, honestly, again, just getting into the issues. Some people are pulling in data and they're getting in, they'll have loans in their, they'll have closed loans in their pipeline. So I think, to answer the question shortly, just going to the hedge report and booking that I think you're gonna come across all kinds of errors. This year I don't think I've seen one that was just a clean, hey, I'm gonna pull it off the hedge report and book the entry, without there being some kind of issue. To answer that question in short.
Yeah, but that being said, it's your best starting spot. And I think, to the data hygiene, is that your hedge advisory firms are only as good as the data they receive. They're great, but they're just working off the data they're pulling from your LOS system. So if the data in your LOS system, including milestones, are correct, the type and the pricing of the loan is there, then all of those things, in that the loans have been pulled off the report. Sometimes we see expired lock loans that are still sitting in there. Oftentimes there'll be loans that have been fully curtailed, and as a result, those fully curtailed loans are not being marked to anything. So those are some common pitfalls, and I think that's kind of a preview at the end here. And to really understand what's in your report is really critical. To Dustin's point, if they are already booking your estimated cost to close out that pipeline, and your data hygiene going into it is correct, then yes, then you have a good number to book. I think that's the right number. If you haven't given the cost to close, then you need to have a separate journal entry to offset that. And then constantly looking at the underlying loans that are making up the value, to make sure that they're actual real loans and they're current and everything's in there, not just that there's nothing that's fallen off that shouldn't have. Yeah. Is that? And I think we saw a lot of that during this audit season with clients.
Yeah, I mean, I think, oh yeah, totally. I mean, I think, if you would ask me that question 10 years ago, I would have said, yeah, just book it off your hedge report and move on. But, I think everybody in the industry has learned, since then, and that, those things, there's all kinds of issues. I mean, we've seen issues, I saw a lot this year that not all loans are getting to valued, whether they're, that whether they're, like Mark said, they're curtailed, or maybe they're not including their best efforts piece in there, or whether it's
I also
pipeline.
I think this year we had record volumes also. So the LOS systems, the input in this, there were just clients had fallen, a little bit behind, and that's a kind of a reality of huge, when years of people are scaling like mad and trying to keep up with volume, that happens. But yeah. All right. So let's go to the next part. Well, let's see. Did I get through all the fair value consideration things we wrote down? I think we did. Top issues in recording assets and liabilities at fair value. How does loan level accounting kind of help with this issue? This is kind of an interesting topic. I think oftentimes we have clients that have adopted software and have good loan level accounting versus clients that are trying to manage through other software packages that are kind of more out of the box, and how that relates. So Dustin, during the audit season this year, what did you see as it relates to these assets, and how loan level accounting either helped or actually mitigated some of those issues?
Yeah, no, it's a great point. I mean, I think we talked about some of them just a little bit ago, but I mean, on the loan level accounting specifically, I mean, people will ask us that a lot of the times with the hedge entry. Oh, do we book this at loan level? Do we not? I mean, that's when we typically don't recommend to book at loan level. You just book it, you have it, it's just a lot to track if you're going to do that. And, they're not all going to close. They're not all going to pull through. But on the loan held for sale side, I mean, that's a key thing. Clients that are still using, the QuickBooks of the world, they're prone to errors on this, because it just doesn't, it's hard to get to a true loan level, basis in QuickBooks. And you can't, a software, like Loan Vision, you can honestly, search, filter, whatever off of any key point of, loan data. So, it makes it much easier to go in. You can see that, hey, every one of these loans has an associated fair value. And if it doesn't, you can identify why. That's probably the biggest piece of the loan, getting to the loan level. You can also go in. I mean, so this is some of the errors we saw this year. I mean, you can go in, you can take a list of your loans held for sale and bump it up against your, your servicing portfolio. I mean, we'll see sometimes they're double counted. Again, they're, you have something in your data that's triggering, your hedge valuation, or not your hedge, sorry, your MSR valuation firm to pick up, those loans that may not have been moved into the servicing portfolio yet, that are still a loan held for sale, and you may be double counting it. We saw that a couple times.
Because it didn't transfer over to the servicing portfolio. It's still sitting on loans held for sale. Yeah.
Yep. And you have a value associated with it over in the servicing portfolio, so you're double counting a value there. So just having that loan level detail makes it easy to again, it makes it easy to look to make sure it's not in two places, that it's not being double counted in the servicing portfolio, or it's not being double counted in the hedge if it's a closed loan. Yeah, and then you can also, again, you can go back to making sure that if you have closed loans, that you have every loan has an associated fair value, that or if it doesn't, why. I think those are kind of the big things when you're getting to the true loan level accounting piece of it. So.
Yeah, and I think some of the other pitfalls, loans that have been bought or paid off, you've paid off the line for those, and you're actually kind of doing interim servicing, but it's still held for sale. There's a fair value that's associated with that should be looked at. Common thing we see. And then how about signs being reversed? I think you would think that that's not as big of an issue, but it's a pretty easy thing to do if you think about these entries, especially if internally you're used to booking, a cost in your derivative instruments is going to be a hit to your P&L, and all of a sudden you're in the money, but you're out of the money in your loans. It kind of goes the other direction. So maybe you can talk through that a little bit and ways to double check that.
Yeah, I mean, I think the most common spot we see signs flipped is in the hedge instrument and the corresponding pair off payable or receivable. I mean, if I think that's been, over the last few years, that's kind of been, consistently a liability more often than not. So I think people are used to just having that as a liability, especially if you're newer to the space, you're constantly booking it as liability. Well, I think we all saw it in, February and March. We saw that flip. I mean, we saw, margins went significantly down, so that, the value of that's going up, which it should. I mean, that's why you're hedging. That should be, you should be making gains on that. And so, we saw a few people in February and March that, just booked it as normal and booked it as a, whatever account they were booking it as, booked it as a credit balance when it was, big O. And we're talking, $1 million swing or $2 million swing from one position to the next. So that's probably the most common spot. We see it. I mean, I think most everybody knows that, the pipeline's an asset, even net of cost. The MSR is an asset. So, I mean, there's not typically that. I mean, when you get to cost to close, maybe if you're booking the cost to close entry separate, from the pipeline, the gross value, we'll sometimes see them flip that entry and they're booking that, so they're increasing their asset value instead of decreasing. But it's really that hedge instrument that people need to pay attention to when they're booking that off their hedge firm report. So because they just give you a number typically, and if you're not paying attention, you can book it real easily the wrong way. So.
And it's also when that critical thinking comes into play too. I think oftentimes accountants kind of dig in and they are just going through the motions, and they sometimes you need to step back and say, does this make sense? I mean, do your gut check. Take a minute before you deliver it to the owners and the CFO and the CEO of the company. You want to make sure that financial makes sense, right? And this is going to play a huge factor in that. And oftentimes it's simple. Your debit's where your credit needs to be, and since you're doing those entries all at the end of the month, that has a huge swing.
Yeah.
I want to make sure we're encouraging questions. I think there is a question that has come in.
Yep. Yeah. Sorry, go ahead.
Go ahead. No, you go for it.
Oh, no. So one of the questions we got in is, why don't you recommend recording the hedge by loan?
Yeah, I mean, it's a question we get sometimes. I don't know, we'll tell you on the entry, calls and stuff like that. I mean, I would think if I was sitting in a controller or CFO spot, the reason why I personally wouldn't is because, you don't know if that loan's pulling through. You don't know, so you're going to get it all booked on a loan level, then you're going to have to reverse it if it doesn't pull through. They ask about hedge cost and making sure, what was the question? Record the hedge by loan. And the hedge cost side of things. I mean, that's the hard spot too, is you can't allocate the hedge cost down to a specific loan. I mean, you don't hedge on a loan by loan basis. Should have probably mentioned that at the beginning, but you hedge on a bulk pool of loans. So you hedge on $10 million, type thing. So it's a little hard to allocate that out. And I mean, that's been a question for 10 years I've been getting, hey, can you allocate that out? Is there a way? Some of the reports will try to give you an estimate of that, and they'll try to get you into that number. But again, it's just more of an estimate. I think more than anything, it's just cumbersome. I mean, it's a cumbersome process to get it in there to book it all on a loan level basis. And then you're adjusting it for pull through. You're doing all that. I mean, if you have an upload, maybe you could figure out how to do it, how you upload it straight from your hedge report. But yeah, that's really it.
Yeah, and I'll add real quick to that. Yeah, you're right. I see somebody said MCT has a report. Yeah, they do. They'll do they have a method for taking the pool of loans, and it's like to clarify that a little bit further, if you go to fund the Wilson loan, your hedge firm doesn't go out and buy a position for the Wilson loan. It's the pool of loans based on the average age. There's lots of things that go into that, depending upon the hedge advisor firm and their methods, but they're generally similar in that. So on a loan by loan basis, it's not going to be perfect, right? There's no such thing as a perfect hedge. You could certainly try to do it on a loan by loan basis. That wouldn't make it incorrect. I would just caution you that, at the end of the day, the fair value that this particular assets, it's based on the pipeline of loans, not necessarily on a loan by loan. So it's the pool of loans is what creates the asset. It's these interest rate lock commitments cumulatively that have a value to the company. And those are usually separate, a little bit separate than the overall just on a loan by loan basis. So, but that comes down to, what you guys want to do. But I will tell you, I don't know anybody that does that on a everyday basis. It's always done at the end of the month. And some will try to attribute it to your actually pipeline loans, but yeah.
In the MCT report too, just to clarify, I mean, I think you said this, Mark, but just to clarify, I mean, that is again just an estimate of the cost. I mean, they're taking, and I don't know what they actually do. I don't know if they take it just do a weighted average and multiply out the cost and do that kind of thing or whatnot. But it is it's an estimate of that, not
So we had another point just come up. Excuse me. What at the end of the day, what's the value of allocating that cost at loan level? Because like you guys said, you can't really control it and it is cumbersome. So is it really worth all that trouble?
Yeah, no, I mean, I think best practice to do at the end of the month. That's what most of our clients do. I think when you're compared to your peer group and you're getting warehouse lines and the users of the financials, they somewhat expect you to follow the same method that everybody else is. And so that's another reason that, fair value is used. Okay. So let's, so things to do when reviewing financials and fair value before issuing. Make sure you guys keep asking questions if you have them, but let's go through this real quick. We have a few bullet points and then we'll open it up to any additional questions, but Dustin, take it away. When reviewing financials and fair value, what should you do before issuing?
Yeah, no, I think the first key at the highest level is review them, have a second set of eyes on them, have a, whether that's, I know, again, looking at the list, we have accounting departments of various sizes on this list. And we have some that are probably as small as 1 or 2 people and some that are, 10, 15 people. So, especially in those 1 to 2, person departments, obviously, if nobody better than, nobody else, at least have the CEO or COO look at them before they get issued externally. Ideally, you'd have, internal reviews on them. Checking things like that, though, that we kind of talked about, and just to summarize, checking the signs are the right way, checking to make sure that, you can analytically very easily look at some of this stuff and catch errors. You can, take the fair value, straight off the financials, the fair value of your, of your loans held for sale and divided by the notional amount of your loans held for sale. And you could see that, we caught so many errors this year that number was 2% when we know that should be, up around 4% or 5%. And so right off, hey, they're not including fair value in all their loans or something to that matter. That's the place to start, is just analytically look at stuff and just, hey, this doesn't look, right, or doesn't look, doesn't feel right type thing.
Right. So. And also look at the type of loans that are being valued. If you have a, bond program, some of these DPA, some other loans that are sitting there, they shouldn't be valued with, your same VA and FHA and conventional loans, because they're going to be a much different valuation.
And then, yeah, I mean, then if you are the, the controller or the accounting manager or whatever, I know CFOs can be doing this, but I mean, make sure stuff agrees back to, supporting files. A lot of times, you'll go in, you'll book an entry, back to our original very first question, somebody will go in and book an entry just based on, MCT does a good job laying out, here's your entries tab. So they'll just book that entry, but maybe they don't go the second level and make sure that it agrees. We get that a lot, especially with the clients that are, have smaller accounting departments. We'll ask, hey, well, where's the support to this? And they're like, oh, we just booked what MCT told us to book. And so then we need to dig around, and that theoretically, you could do that as part of close. You tie it out to the, the detail of, the loans and the locks and stuff like that.
Make sure that the data is good in the report. Just cross check that with your pipeline reports and make sure they tie out. And all those things are really important. For making management decisions, and we have a pretty robust accounting outsourcing group, but we see this all the time. So when you're looking at fair value and you're making decisions on how to run your company, we often recommend you want to really look at what's actually funded to make those decisions, right? So oftentimes you're paying bonuses to branch managers and other things. So when you're evaluating your financials, there's a way to look at that. And we always recommend that you strip out the open pipeline fair value entry when looking at that, because those are loans that haven't been funded yet, right? So not necessarily a GAAP consideration, but this is an internal management view of looking at the financials. So when you're looking at that, you really want to take a look at that, what's funded in the month, to decide how things are going. And if you're, depending upon your comp plans, if you're rolling those over a month over month, you might want to look at a 3-month rolling average. That gives you a closer preview of how you're doing from an operational perspective. So, and even on your hedge. So when you're evaluating your hedge, you whether or not you like it, and it's generally, it's a good thing to do. And you're, by delivering on a mandatory basis, you're going to make more money. But when you're evaluating it, it's over a period of time. And we always say when evaluating, at least look at 3 months at a time, because 1 month over 1 month it can be hard to determine that, especially if you have just huge swings in pipeline. So in a building pipeline environment, you'll have increases in your overall net worth. In a shrinking pipeline environment, it might be going the other direction. So just look at that and make sound decisions based on that as the asset moves out. The touch on the cash to accrual, cash basis accounting isn't really an option for probably anybody on this call. So you need to do accrual based GAAP accounting. Cash basis is interesting, but it's really not even an option for most of you from a tax perspective. It's just and you can get close to making management decisions based on what we just talked about, and still keep everything.
That's an interesting point, Mark. I had it written down. I didn't have it on our original agenda, but you brought it up, and I had it written down too. It's kind of, you want to talk about just briefly the tax treatment of each piece, just real briefly. I mean,
yeah. So I mean, obviously on the derivative assets themselves, the loans funded, held for sale, that's income for tax, just like it is for book. There are portions of the amount of your locked open, not funded, that get backed out for tax purposes. So you want to take a look at that, make sure that's being treated correctly. Similarly, some of the MSR, there's excess MSR values that you have to recognize as income in per tax, but there's a portion of that you can exclude. So it's from a high level, that's how it works. Obviously, we can help navigate any of that stuff for you when it comes to tax time, but which we're kind of in right now, aren't we? but yeah, so anything else on that you were thinking of?
No. I think, the tax treatment is favorable on at least the pipeline and the MSRs. And I mean, just one step further on the MSRs is if you do go to sell them, a year down the road, there is, capital gains treatment on that, on that gain. So, again, it's another favorable position that you can, get capital gains rates. So,
yeah. So some good tax considerations there. Some of the blocking and tackling, I encourage you all to reach out if you need some help on actually looking at the entries. I know we have a pretty wide range of experience levels on this call. So if there's anything we can help you with as a firm, please let us know. We're happy to do that. We have a slide deck also that kind of walks through some of those steps that you take when you're recognizing these assets and liabilities on your books. So we're happy to share that. Are there any other questions? We're about at, we're 2 minutes over than I promised, darn it. 2 minutes longer, but I'll make sure that we have any questions, let us know.
Yeah, and also if we end the call and you guys think of questions, you can absolutely send them to me, or you can send them to Mark and Dustin. If you send them to me, I will obviously field those questions onto them, because as you could tell from the call, this is definitely not my area of expertise for my whole 3 words after my intro.
I just want to thank you for staying awake. That's what I'm really happy about, because this is what, when my wife has trouble sleeping at night, she says, "Will you talk to me about derivative assets so I can?" So
there was a few times where I was like, "Oh, prop your head up a little bit more there."
More coffee. No, we like this topic. So for us, I could talk about it all day, but I know that it's because we're weird. So anyway.
No, I want to thank both of you for sharing your expertise in all this information. As I mentioned earlier, this call is being recorded. Not only will we be sending it to everyone who registered, we're also going to be posting it on YouTube. So it's accessible to you guys whenever you want to watch it. Whenever you need to put your kids to bed, you just pop this recording on.
Ouch. It's true. It's true, though. It's true.
All jokes aside, guys, thank you so much. I appreciate it. And everyone, thank you for, we had a question just pop in. Awesome. Sando said, "Good job, guys."
Thank you.
Alrighty. Thanks, everyone. We'll talk to you guys soon, and have a wonderful rest of your day.
Thank you.
Thanks. Bye-bye.
Bye-bye.